professional real estate investor, I've realized one thing is that our views of the market may sometimes go against what is presented in the media. And some of the results that we get may also differ from our opinion and our choice. So for this evening talk that I will be presenting to you analytics and also facts about the locations that is where Forett is situated. I will be touching on perspective that is my view and my recommendations. So if it differs from future results, then I would have to make a disclaimer. All right, because as a real estate practitioner, all of us, all right, have a different point of views. All right, and also I believe some of you here are very seasoned real estate investor and also real estate analysts, maybe in the session tonight. So take it with a pinch of salt that our opinion may be first. All right, so as a real estate investor, in order to succeed in multiplying your asset, there's 3 important points that I'd like to share with you. All right, 3 very important things that you need to do as a real estate investor. All right, these are the 3 things. Number 1 is to plan. Number 2 is to evaluate. And number 3 is to decide. So you can't do without any one of this. It has to go hand in hand. You have to plan, you have to evaluate, and you have to decide. Well, if you don't plan, and you can never know how to evaluate, and you can never make good decisions, and it has to be decisions by luck. So whatever results that come forth, it is mainly from the initial step that you take is planning. Next is evaluations. Many times evaluations comes from the opinions of others. And also, if you have done it before, it is from your own experience. So evaluations can be based on numbers. Evaluation can also be based on experience, which is, it could be even based on mistakes that we have made. All right, and finally, the decision-making phase. If you have done it before in real estate investments, you know that the sooner you decide, the better will be your result. So these are the 3 things that I always have in mind when I talk about real estate investments. So in ERA, what our agents can provide for you is also these 3 things: to plan, to evaluate, and to decide. And we create tools in ERA to help our customer achieve results in real estate investments. So recently we have introduced a super tech tools that is called the iERA Robo-Advisor, because we want to create values for all our clients. Well, the first value to you is to help you to plan. So in iERA Robo-Advisors, where all our agents are equipped with, we are able to provide you with home investment plans that is based on your unique financial position. Make no mistakes. One man's positions differs from another. My positions differ from yours. So my decisions may be made based on my financial position, but not you. So it is very uniquely yours. So whatever you decide has to be unique, yours. So our agents are trained to help you and provide you with home investment plans that can be auto-generated from our iERA Robo-Advisor. And through the advisor itself, we are able to access to your scenario, whether you have already owned a property or not, or whether you have jointly owned a property that is like HDB flats or private property. So from the scenario, we are able to present you plans that is suitable for you and your spouse. And we can also create plans for individual, which is a spouse buy 2 properties separately. So from all these auto-generated plan, the second values that we can create for you from this IERA robo-advisor is to help you to evaluate the best home investment plans with detailed analysis. So when I say detailed analysis, I don't just mean how much down payment, how much cash is required, and how much loans is eligible from the latest TDSR measures. All right. I also would like to present to you investment analysis that will display the cash inflow and outflow over a holding period of that property assets that you will be investing. And in the robo-advisors, we are also able to present to you the profit and loss and the ROI and the ROEs. Well, finally, the values that we create for you is to decide, is to help you to arrive at the right decisions. So this is only possible if we can provide you with financial prudency by assessing your risk tolerance to unforeseen financial setback, especially in current situations. Because of COVID-19 pandemic, it is unprecedented that some of us may lose our job. So what happens if a job is lost? Then financial income will be affected. And how will that affect on your property investments? So make no mistakes. Risk assessment is important in all investment because real estate investments is never a saving plan. Because real estate investments encompasses risk. This year may be up, next year may be down. Next year may be up, next year may be down. It's unlike a saving plan with a constant return. So real estate investment, because it encompasses risk, we have to be financial prudent to assess the best case scenario, the worst case scenario, and possibly even the nightmare case scenario. At ERA, we took pain to put all this in our robo-advisor to present to you values. So if you are our consumer, I'm glad to say that you are in good hands. So after tonight's presentations, I would like to invite you to continue to Zoom with our fellow teammates, ERA sales professional. They will be able to continue the presentations to you over Zoom and help you to arrive at the right decisions. All right, so without further ado, let me just show you and present to you this chart. It's familiar. It's very familiar to all of us. This is the private property price index over the last 45 years. How many years? 45 years. So over the last 45 years, there are many ups and many downs, many good news and many bad news. So what I would like to show you is that for any kind of crisis or for any kind of setback, there is always a rebound of the market. And whenever there is a bull run in the market, don't be too happy. There will always be a bear that is hiding, that will present itself at the most unexpected time. So real estate investments comes with all these risks. All right, we have experienced all this over the last 45 years. Over here on the screen, you can see we have the recent global financial crisis and right now COVID-19 crisis. All right, we have gone through SARS.com bust, September 11, Asia financial crisis, world economic crash, oil crash, and the latest suppression measure called the cooling measures. So with so many challenges in the market, I would like to understand more about the growth of Singapore property market. You know, most recently, one of our staff in the office, and he's our chief valuer. We have a valuation department in ERA. So our valuers send me a price list of Serangoon Garden landed house back in the 60s. So the land that was purchased by buyer during then, all right, for a standard size of 2008 square feet land in Serangoon Garden. Guess how much is the price then? During the 60s. It's only $12,000. And how much is the price of a 2008 square feet land right now sitting in Serangoon Garden? It's about 3 million. So ladies and gentlemen, I quote you this example is that in the 60s, it's not even in this private property price index. All right, the price level is at this level. And right now, the price level is here. So is Akka telling you that in over then, this is $12,000, and right now it's 3 million. And you can calculate how many times is that. Possibly the growth is like Amazon shares. So you have gone so many times, all right, despite so many crises. So let's go into more numbers to show you what is the duration of that bull run and also the magnitude of the rise and the fall. So over the many years, the market actually crashes during the crisis time. All right, as much as almost 45% during the Asia financial crisis. But right now, the fall has actually tapered, all right, to smaller magnitude. All right, but if I want to look at the market growth over the years, the market growth multiple times after a crazy fall. There will be another even more crazy market bull run. So a conclusion that I can make about the Singapore property market is that the percentage gain over the years, it's more than the percentage loss. Now, this is a property investments. Investments encompasses risk. So if you gain, as long as your upside gain is more than your downside losses, over time, your investment will be okay. So Singapore property market trends move from point A to point B. So point A to point B is called a uptrend. So we are still in that point A to point B situation, which is in that uptrend because of many rights fundamental that is put forward by our generations of leaders and also the people that works very hard, all right, in this industry. If we look at the non-landed residential prices excluding ECs, all right, if we just look at a time frame of 20 years since year 2000, okay, the per square foot price of any non-landed residential during then, all right, is at this level, which is say about $400 PSF, all right, 400 PSF. And right now we are at this level, which is like 1,006 PSF, right? All right. So at 400 to 1,006 PSF, are we looking at about 4 times over the last 20 years? Is this a good wealth multiplier? Well, certainly I think so. But there is always this thing called resistance and support from point A to point B. You know, when the market is moving up, it will be capped by 3 things that I'm I can share with you. Maybe there's more than 3 things. To me, the market moving up can be kept by cooling measure, can be kept by recession, can also be kept by slow growth in income and possibly unemployment rates, which cause dent in market sentiment. So resistance will be caused by these three factors. All right. Of course, the support level that defines the market prices will also be something that we as investors should take note. If otherwise, you will miss a great crisis or possibly even miss a great opportunity. So the support that I'm talking about right now, it's 3 things that I also can think of. Number 1 is government stimulus. Number 2 is low interest rate environment. Number 3 is liquidity in the market. These actually give support to the property market. So my friends who are non-real estate agents and my friends who are investors, very often we chit-chat about our point of view of the market. And the question usually posted is, will the market crash? My answer is, it depends on the market support in that country. So in Singapore and in the world right now, we are in a very low interest rate environment and high liquidity situation, which means there's a lot of money supply in the market. And government throughout the whole world is raising to help the economy, to restart the economy, and also to stimulate jobs in the economy. So all these are factors that will support and prevent property market crashes. Particularly about the money supply in the market. If we look at just a few years ago, when the US Federal started printing cash like nobody business, it is inevitable that investors hold cash will look for the asset class that will not depreciate like cash. So property comes as a favorite. So when money supply is up, the property's price index will be up here. So when there's QE1, the price go up. When there's QE2, the price go up. And when there's QE3, the price go up. And now there's QE4. So it gives support to the market. So even if the price don't go up, it will not crash because it balances off. All right, the demand for real assets is very real. And what about interest rates? Yes, we are in an ultra low interest rate environment right now. The SIBOR has fallen to, the 3-month SIBOR has fallen to 0.44. All right. And what's so good news for real estate investors? Because the appeal of real estate investments, especially in an ultra low interest rate environment, brings benefit to mortgagee, all right, to the lender. So why? Because there is cash flow positive, all right, as the average rental yield have outstripped the mortgage rates. All right, I take a closer look on how much, what is the kind of interest rate that the banks actually charge for the transaction. And it's SIBOR plus 0.8%, all right? This is for property under constructions, for BUC residential, OCBC 3 months Singapore interbank rates, SIBOR plus 0.8 for year 1, and that is only 1.24%. All right, so if I were to show you over the years, all right, the average island-wide, which include the, island-wide includes the CCR, RCR, and OCR, and that is shown by the green line. All right, this is the yield, the gross yield of all the regions. All right, the gross yield of all the regions. So in Singapore, the gross yield of all the property is about this. All right, close to 3%. And the mortgage rate, all right, suppose if I put it SIBOR plus 0.8 right now. Okay, so right now it's here. SIBOR plus 0.8, it comes to this point here. Otherwise, if we backtrack all the way to 2004, it's up and down and down. And the effective spread, which is the difference between the gross yield and the cost of lending, all right, which is the mortgage rate, is shown by the blue color bar. All right, the higher, the better, because this money that you pay for your investments will goes into your pocket. All right, so if you have a situation that is like that, okay, that is a no good, because you are making losses. Your money go outside your pocket. But if you have a situation that is like this, all right, that is very good, because money comes into your pocket. All right, especially like that now, when your yield versus mortgage rate spread is increasing. It's excellent opportunity to park your money into real estate investments, because you put money into your pocket, not into the bank's pocket. Does it make sense to you? What about the appeal of private housing over the years? Well, if you have studied the market closely, and if you have been communicating with ERA agents, all right, my agents probably have educated you that you should be going for private housing rather than HDB resale. Because over the years since 2013, HDB resale index was down 11.2. And since 2017, private housing has risen 11.6%. One is up, one is down, about the same amount. Okay, this shows you that in the year 2017, there was a big recovery for private residential. All right, so private residential actually went up. But HDB continued to slide. So over the years since 2013, the same starting point here, now different. All right, right now different. So if you are a savvy investor, if you need to park your money in real estate, would you park your money in private residential or HDB resale? Okay, this is based on the fact that we have understand about the market and the devaluation effect of leasehold HDB flats. Next is the appeal of new homes over resale. So over the years, we have also experienced the buyer's behavior. And I would like to share with you as a market watcher that most buyer prefers to buy new home nowadays. Right, it's like you guys go and buy a car, you prefer to buy a new car than a resale car. But whether you buy a new car or resale car, at the end of the 10 years, you don't have much value. All right, but for property, you buy new home or resale home, at the end of 10 years, you will have value. All right, it's just that which one have more growth. Both will have growth, but which one have more growth? So the appeal of new homes seems like there is better growth, all right, than resale home. And I get back to our ERA tech tools. All right, we have a tech tools that is called the iERA apps that power our agents to understand more about the market trend. And I do a case study using the iERA apps analytics. Okay, we have this analytics feature that is inside our app, all right, that can present to us if you were to buy new and to sell at resale. All right, for example, in District 21, this project that is called the Beverly that is launched in 2009. All right, someone buy at June 2010. All right, so that is like buy new development. okay? And there are transactions that is concluded in February 2018, and that is a period of about 8 years. All right, the average growth in the PSF is 27%. Okay, so that is buy new and sell it in the resale market after about 8 years. So for that same time, if 2010, someone buys the Cascadia, which is also in District 21. It was launched in 2007 and TOP in 2010. So that is the first owner who sold it to a resale buyer. So you buy resale, you buy a TOP property, it's a resale property. And 10 years later, you still make. But the thing is, your growth even extend another 2 more years from 2018. All right, now I'm looking at 2020. All right, it's still 9.35%. The other one is 27%. So how many times different? My God, that is like 3 times different. All right. So if I go into more details using the IERA condo finder, all right, I'm able to see the past transactions, okay, of Beverly's property and Cascadia property. All right, one is a new home, buy new and sell in the resale market. The other one is buy resale and sell in the resale market. You see the difference? The difference is the profit growth lah. All right, the gain is different. One is 722,000. The other one is 142,000. So that is the difference between buy new, sell in the resale, or buy resale, sell in the resale. The kind of price that you have to come out is about the same. All right. So are you convinced that you should be going for new homes than resale? If you are not, let me tell you this, I have another tools in ERA that has helped my agents to also talk to investors that they should be buying new launches, because new launches have better ROI and ROE than buying a resale unit, assuming the same annual growth rate. So what is ROE and what is ROI? Now, returns on investment, that's the ROI. All right, it's equals to the capital gain divided by the purchase price, all right, in percentage. Because the return on equity, which is ROE, is the capital gain divided by the own capital use. It means only the cash portion that you use. The other portion that is the bank loan is not part of the capital use. So with the ROI and ROE that is in place inside the IERA robo-advisor, we can do case study for you. Using the IERA robo-advisor, a new condo unit versus resale condo unit of the same value. All right, so this is a plan that we recommend to a buyer, Mr. and Mrs. Lee, all right, to buy new condos. Okay, the price is 2.322 million. The other plan C is to buy a resale condo, also 2.322 million. Same price. Okay, one buy new, one buy resale. And what happens when we generate out the analysis report? All right, the profit and loss over the years. This is first year, all right, second year, third year. All right, the first 3 years, any investors inside this, in the audience here, you know that you should not be selling your property because you have to pay SSD. Yeah? So first 3 years, see, if you were to buy any property, that is negative. If you were to sell away. All right. Similarly for resale, there is negative also. All right. But on the 4th year onwards, for new homes is where the property is TOP. On the 5th and the 6th, the 7th and the 8th and the 9th and the 10th. All right. What do we see? We see returns, ROE, that is a higher value, all right, than the resale. Both also have increased in growth. It's just that the ROE is higher for new homes. How to explain this? Because in new home development, you pay progressive payment. There is a financing schemes that allow you to part your payment in intervals, all right, that is stretched over a period of 3 years. But for resale property, you know, you got to complete that deals within 3 months, all right, for most cases. So within 3 months, you have to part your payment, all right, in that 3 months, which means money out from your pocket faster than money come into your pocket. Whereas for the new launches is that money out from your pocket goes slowly. So you actually pay lesser. That's why your ROE is higher. And over the years, even if you keep your new development, over the years, your growth rate, all right, based on the same price purchase, same growth rate per year, if we make that assumption, the ROE is better for new launches. That explains why there is strong new home sales. One of the reasons for declining resale and sub-sale also. All right, over the years since 2016, all right, the peak of the resale market is actually in the year 2017. All right, but however, the new home sales is very consistent. And in fact, in the most recent pandemic, case transactions are concluded, all right, without seeing the show galleries. And it become a trend now. All right, maybe some of you have already give your check and don't even bother to go to the show galleries. Am I right? Because there's no need. Because there's no need for that look and feel. You probably don't even need that. And we have this experience after the COVID-19 circuit breaker, and at the same time from the sales that is coming in, there's strong underlying demands for new home, all right, that bring us realize that the development sales volume actually went up during circuit breaker. And when the reopening of the show flats in June, all right, there was a big rebound in the numbers. Okay, since April during the circuit breaker, the numbers have gone up as much as 2.6 times. So one of the things that I want to share with you from my research is that the prices of the residential market is very much supported by rising new launch units sold. So I've asked my research team, okay, to look into the new launch units sold over the years, the last 20 years. So the red bar represents the number of units sold. So when the number of units sold increase, all right, you can see that there is a lot of support for the price. So in the good market, when there's a lot of support for the price, all right, see, this is volume, the price will also move up. And when there's good support for the market, the price will move up. So right now, if the market is not so good, or so will the market crash. If it don't go up, all right, it will not crash because of the volume that is shown in the primary market here. It will not come down because of the support that is caused by the rising new launches units sold. Okay, so much about the macro and the micro of the market. All right, for the next half an hour, I will be presenting to you your investment objective. Okay, I have investment objective. These are the investment objective of most investors. Number one, capital gain. Number two, rental yield. And number three, wealth retention. All right,